Sandeep Tandon joins us now. Let's take a conversation forward with Sandeep Tandon to understand where he feels the markets are headed now. Sandeep, first let's understand your view. Are we nearing a panic bottom?
So I think last time also explained the best way of looking the fear and when this uncertain environment is through, let's understand through global volatility of fear index. Okay. Now the global volatility, the VIX itself has spiked closer to 37 mark, and since then it has corrected, and so is the case with India also. Okay. Now let's understand two things: whether we can say with good amounts of confidence that volatility has peaked out. Maybe answer is yes. It looks like the volatility has peaked out, which means that fear is also peaked out. Okay. But should we say that volatility has settled down? Answer is clearly no. Volatility has still not settled down. Let's say India, which should come down below 20 odd percent. We can say that this volatility is settling down, and then we can be more confident about participating more aggressively. Okay, and so is the case with US also, maybe closer to 37, 39%. We have seen it has to also correct below 20 odd percent or below 22% before we can take a very aggressive view. But if I go with the probability that whether we have peaked out, answer is yes, because we work on the volatility band theory, because we believe this is not a world war like a crisis sort of thing. This is a small invasion which is unfolding right now. So it is very unlikely that we get into the last phase of the band of the volatility, which means that India VIX has to cross above 36% mark and the global VIX has to cross above 39%. If that happens, then it's a clear indication that we are heading for much bigger crisis. But given the news flow, given the data which we are seeing right now, it doesn't look like. Okay, so that's the reason I'm using the word on the probability side. The probability is that we have already seen the spike in volatility, but volatility is still not settled down. It might take few more days before it settles down. And I also just want to remind you, let's understand this implication. In fact, in the month of December, okay, on somewhere closer to 18 December till or 20 December till 18 January, we have seen extraordinary spike in the market, which was like as good as 12% move or nearly 200 points move we have seen. So market is actually preparing for that because market is very, very light and assuming that if things settle down in next 3 or 4 trading session or maybe this like this weekend sort of thing, then market can also give you equally sharp up moves, the way which happened in the month of December. In the 8 or 22 trading session, 12% move happened in the Nifty. So I'm not ruling out that probability also, that scenario also.
Markets have typically made a panic bottom if I look at the COVID volatility or the GFC volatility, which have gone to 50, 60, even 80 times. So we are still in late 20s and early 30s.
So see, COVID and GFC1 and GFC or GFC2, we can call it so COVID. I don't think that is the situation right now. Okay. It's not that vulnerability is not that high the way we were dealing with what happened in GFC1 or what happened in COVID, which is completely chaos and uncertain environment globally, this is right now one area or one pocket of area, particularly in Europe, where this crisis is unfolding. You look at what happened in a few months or months back in the Afghanistan. Something similar situation was there. Okay, and we were all worried about it, and it settled down. Okay, I personally, the way we are reading the statement, the way we understand geopolitical environment, I don't think we are heading towards any sort of bigger world war sort of environment which people are generally worried about. It's an invasion. Maybe it has deep impact on the Russia and up to certain extent Europe. But let me give you some more example. Okay, see, I'm a data-driven house. So we with the word quant, we quantify everything. Let's look at the biggest impact. Ideally, should have been on natural gas. Okay, the natural gas has been very stable. In fact, natural gas spiked from December low to 3.4 or 3.8 to 7.5 odd percent. It's more than nearly 100% up move we have seen in 1 month's time, which is not the case right now. And Russia is one of the biggest supplier of natural gas in Europe. So it gives you indication that the way we are reading the market, maybe Europe is also not reading. Okay, the noise levels are much more than the actual reality. So even you come to the crude market, the crude volatility has also not spiked up to that extent. Crude and both gold and silver was gradually inching up. Whenever we have seen any situation like this, we have seen a sharp spikes in crude, which has not happened. And third most important thing you look at from the currencies market point of view, okay, the currency market is also holding on pretty well. The entire emerging market currency is pretty stable. Okay, whether you look at the MSCI emerging market, or you look at the Asian dollar index, or even you look at USD NR, is pretty stable right now. So even currency market is not giving you any signs of disturbance what market is expecting. Okay, so if I just look at data with some amount of rationality, and that's the reason we try to build these indicators, which helps you to take a call in difficult environment. Okay, so none of the data points is showing me that we should be too worried about it. The way whole market is like panicking, so it's like a human psyche. This is a mental game, and people tend to overreact on the long side of the market, and people tend to overreact on the when there's a negative development. So I think we are in that phase where people are panicking, and data is not warranting up to that extent panic the way market has reacted. In fact, Indian market has corrected more sharply. You look at Russia, where the situation is unfolding. The currencies, I have not seen today's morning ruble thing. Let's Europe open. The currency market peak, ruble corrected around 17%, but till Friday evening it's just down 10%. So even in Russia, where things are unfolding, currency market is only down 10%. Okay, it gives you some amount of stability, or let me put with some amount of conviction that situation is not that bad the way market is reacting. None of the data points are showcasing that situation is so vulnerable.
Do you think market clarity and bottom will only come after the outcome of UP election? Today we are talking geopolitics, but starting early next week we'll be talking about the outcome of UP election, which honestly will have a far more importance and bearing because it's a local event. Outcome of a state election, which is a big state, it is coming at a time when markets would like to really say that what will be the impact of the farm rollback.
So my reading is that no, UP election will not be impacted because this is a global event which is unfolding, and global volatility is spiking, global flows are affected. So once this thing settle down, and if the volatility itself, let's say, calm down, okay, then that itself can give you a reasonably good pullback rally. Like as I said, from December to January, what happened? A 12% move happened in the market, okay, and 2,000 points, which nobody was prepared. So I'm not saying that it will exactly unfold what happened there. Maybe something similar can happen. But see, UP election is, it could be a few hours impact or maybe a day impact. Let's say worst case scenario, BJP is unable to form the government, which is the very unlikely scenario. But you look at other way scenario also. In fact, market will react much more positive. They get a very comfortable majority. Okay, so market can give you other way move, and if the seats are less than what is anticipating, that event could last for few hours or maybe a day or so. Because I don't think UP election or state government election will make any major difference at the central level. Okay, and we also have to look at the background that where market has already capitulated. Okay, positions are capitulated, fear index is lifetime high. Okay, with this background, the impact will not be very meaningful.
Sandeep, the other intriguing thing is that, while we're all obsessing over oil and, Brent hitting $100 to a barrel because it impacts the Indian economy, the fact that even amidst the peak of tensions between Ukraine and Russia, natural gas prices haven't spiked up as much. What's your reading into this?
This is what I was highlighting. If the natural gas prices are stable, okay, that clearly indicate the situation is not as vulnerable as market is perceived. Okay, if European markets are not reacting with the natural gas stability is showcasing that something is wrong, but something is not that wrong the way market is reacting. Okay, so I'm very constructive from a longer term perspective because natural gas has actually replaced the crude market. In last 10 years, you look at the overall volumes or in value terms, the natural gas market is far bigger. And that's the reason even in last year in 2021, natural gas from $1.5 has gone up to nearly $7. Okay, which is not the case in the crude. Okay, so it's a very clear indication that gas market is becoming much more mature, and with the alternative resources also coming up, and the impact could be less. Okay, but my simple analysis is very difficult to pinpoint where we are heading right now. But given the stability natural gas prices have showcased, give me comfort in taking this call that one should look for a buying opportunity. The crisis is not that meaningful the way market is reacting.
Sure. Having said that, Sandeep, while, we completely agree with your point, at an index level also, from that 18,600, 18,800 peak or we're around 16,400 thereabouts, and the volatility clearly continues. Forget the index level. What's happened at an individual level with some of the small and mid cap portfolios of investors, they clearly are crying horse. What is the new normal then for the market? And leave the index aside at one point. I'm just talking about purely the kind of correction and pain one has seen from that all time levels in one's individual portfolios at a stock level.
So I think let me give you some more perspective. We tried to capture some of these data points through vulnerability index. Like I have been showcasing right from September 2021, the US market, the vulnerability factor or the vulnerability indicator or index was at multi-decades high. Okay, which is clearly indicate that we were vulnerable. And so is the case with some of the sector, like particular small cap vulnerability level was on a higher side, but no comparison what we have seen in the US market. Okay, so this Ukraine and Russia is a trigger point for unfolding that. But if you really sit down and analyze, right from mid-January, we are seeing good amount of pressure in mid and small, particularly coming from the family office, ultra HNI clients, okay, where we talk about retail unwinding since we run a large mutual fund and we have a good data points from retail investor. Only thing I can tell you, we are getting good inflows. So it's a sample size of mutual funds clearly indicate the retail public or masses is not capitulating up to that extent. And this is a very important observation. Even in March 2020, HNIs and family office capitulated. They surrendered their position and retail was participated and retail turned out to be winner and retail actually made money. So this is the point which I am highlighting for last 2 years. This time we have to identify who is in the driving seat. It is actually retail participants on the driving seat. And this time, again, they have demonstrated they are on the driving seat. In fact, retail buying is on. Okay. So it's a good or great opportunity from a mutual fund perspective who are participating through retail clients who are participating through mutual fund or they are participating directly. This is an opportunity to rebuild or rebalance your portfolio in some of the names where conviction level is high or sector calls or if you have done some your own homework on those other names, one should definitely optimize it because this is a classic capitulative phase where people are just surrendering their positions and the impact cost is very high on low volumes. People are just because sheer fear is unwinding and people have made good amount of money. So a lot of people are thinking, even I have made 120% return. If I'm losing 40%, let me exit. I'm still making good amount of 80-90% return. So that's a mindset which is changing right now. So I think I will look as optimizing this opportunity rather than too much worried about it.
Sandeep, hi there, good morning. And you continue to remain vocal about the fact that value is going to outperform growth stocks globally. And you're seeing that trend as well, having started back home. With that thesis in mind, where is it that you believe there is an opportunity for value stocks to outperform?
So clearly, when we talk about the way we look at value and growth is slightly different. The way market looks more as a statistical tool. If P levels are different or valuation multiples are certain higher levels, people qualify this as growth. The way we look at value versus growth is that from the perception analytics point of view, the stocks which are trading in the most admired category and stocks which are trading in the neglected territory. Okay. So let's talk about sector like technology or consumer durables. They are right from September 2001 or on October 2001, they have hit their multi-decade high in terms of valuation, okay, and in terms of perception analytics point of view, which clearly indicates they were in the most admired category. So those are the stocks or sector which I will like to ignore or try to avoid for my portfolio, where certain sectors like December 2020 metals was there, whether it's media currently or the PSU banks, which is there, some of the PSU themes which is qualified for that. Some of the pharma stocks are now approaching that territory. So the power sectors are there, capital goods are there. So it's not like that you have a very limited opportunity. In fact, opportunity is quite meaningful if you really sit down and analyze these names.
What is the outlook when it comes to valuation multiples and, the overall earnings story having peaked out when it comes to the IT sector?
So if you ask me, I have been very vocal for last few months. We're saying that global IT stock, the perception analytics data has peaked out and it was multi-decades high. Okay. Now, how we conclude this part is very important to understand. Neither we are saying that the prices of these sector or these stocks have peaked out, nor we are saying the earnings have peaked out. What we are only trying to showcase is that the the perception analytics data and indirectly talks about valuation multiple, which means the valuation multiple has peaked out, which means the valuation of these stocks were in multi-decades high, and that has peaked out. We believe these stocks or these sectors now can be at this be market performer, and some of them can be underperformer. So from that perspective, it is clearly avoid from a larger perspective, but that does not mean that everything is speaked out. Maybe you will get some opportunity there also, but it may not qualify as my core holding, but it may definitely qualify for us as a trading positions.
It's a pleasure having you on board and discussing your outlook on the markets. Thanks much for taking time out and joining in on ET Now.